All right, we're live with George Coyle again. So you guys have really enjoyed having George on. So have I. It's a lot of fun to have these chats with George because he has a very a large amount of knowledge of traders, of people trading, good times, bad times, and everything in between. George mentioned an idea that he had after last week's call, which is on origins. So basically. Specifically what George said is I think too little focus is put on struggles or on the struggles of successful people, or sorry, too little focus is put on the struggles of successful people that they went through to achieve their success. And it's glossed over. So I really like that idea. So today I kind of wanted to chat about that with George and just kind of get his thoughts on like, hey, I think that the one thing that everybody seems to be really excited on about George, and so am I, is kind of talking about traders, their mentality, what we think is real, what isn't. I think something that comes up again and again for me, and I just had Shapiro on my show last week on Friday, and we talked about trading being hard and like all the years of doing badly and so on. And I think you can bypass some of those by being learning the risk management ideas. But I think part of human nature and something that I'd love to talk with you a little bit about today, George, is thinking about that hard-headed mentality and how that possibly makes you a good trader, even though at the beginning it makes you a terrible trader. I started to think about that today a little bit. Like that starts out as a bad thing. I think a lot of us have things like blow-ups and terrible things that happen to us as traders because of some of these bad tendencies. But at the same time, it keeps us trading over time.
Yeah, thanks, Jason, for the kind of segue into it. So, I think it expands the idea of the origins thing. I'm not sure if I'm going to call it origins or the struggle is real because I think they're both apt, but origins is more succinct. But it's not really just about traders. It's about, I read a lot of biographies for inspiration or just because I find them interesting. And it's interesting what you find from reading these biographies. So I'm reading The Greatest Trade Ever, which is Greg Zuckerman's book about Paulson. Mm-hmm. And Paulson wasn't really thriving, in the late 1990s. And then he had the greatest trade ever, right? And made billions of dollars and whatnot. And that's not to say he wasn't a good money manager or whatever. But I think the point is, like, when you read his backstory, it's like there was struggle along the way to get to that greatest trade ever. And you find that with traders, but you also find it with all kinds of business people. One that comes to mind, and I've written about this before, is Phil Knight. So I read Shoe Dog, which was the story of the founding of Nike by Phil Knight. And he basically started Nike. It was called Blue Ribbon before. Yeah, I don't remember all the specifics. I'll have to write it down again and get into the details. But he started what became Nike, and it was called Blue Ribbon. And he basically did about 2 years, and it was going such that he had to go get a full-time job. But he got a job as a CPA, and he says in the book he was thinking about shooting himself because the last thing in life he wanted to do was be a CPA. And he did that for 7 years. I think maybe 6 or 7, but let's say 7. So he did that for 7 years, like running Nike on the side, and he had people working for him. But it was 7 years of doing stuff he hated until he got to the point where he could leave his CPA job and go work at Nike full time because it was viable enough for him to go. So I just think it's interesting because I think we're in this sort of success porn era in our culture, at least in the West, where we look at Elon Musk or whomever, and everything he says is gold, largely because he's rich or whoever it may be. And, their ideas can be interesting, but we value this above everything. And we don't sort of pay much attention to the struggle that they went through to get there and sort of the role that luck to a degree played in getting where they were. And, I think the biggest thing is okay, some people get lucky right out of the gate, right? You just get into the right market, right time, minimal competition. You have the right attitude, the right risk, and it all goes really well in trading. But in the case of Phil Knight, obviously that didn't happen. It took 7 years to find luck. And so more and more, the more biographies I read, traders or others, a lot of times people have to go through these multi-year windows of suffering, for lack of a better term, before luck finds them. And I think that the more that I can use my research skills to sort of identify that and present it to people, just that portion, the better it might be for us collectively to just have a sense of what it really takes to get where we think we want to go. And it's to the gloss over comment you made, or the, quoting what I wrote, but it's like Druckenmiller talks about how he started his own firm and he had, nothing really going. And then the bull market started and he was good to go from there. But it's like, there's something unspoken, and it's like, well, how did he raise money? Who did he go to? How did he get those first assets? It wasn't all just appreciation. And I think those are the stories that really I'm interested in these days, because we all love rags to riches stories, right? Harry Potter, Star Wars, Avatar, Breaking Bad, it sells very well. But I think the more that you can study that, or I can study it and share it, it's going to be something that provides both inspiration, but also kind of a roadmap of what it takes to become successful. And obviously within that, I'll do some stuff on traders, but I think Jack Schwager's done a pretty good job of covering the trader part of it. So anyway, I hope that's not disappointing, because it's not all about traders, but that's sort of the idea behind the origins.
No, I mean, I think it's important in a lot of different sense, right? Like, reading Steve Jobs' book. It's a great book. Have you read it as well, George?
I don't know if I read it all, but years ago I read it. But just as a quick aside, the one thing that sticks out to me is like he used to soak his feet in the toilet.
Yeah.
And like that's another thing, right? Like we sort of idolize Steve Jobs, but it's like if your random middle employee like soaked his feet in the toilet, he'd be fired. So yeah, I just always thought that was like the biggest thing that stuck out to me about his book, was he didn't sound like a very nice guy, and he soaked his feet in the toilet, and most people would probably have the police called for that. So anyway,
I think he would have had the police called on him for most of his life. I mean, he did a lot of really different things, very odd things. He was a very odd person in general. One thing he thought that his diet would mean that he didn't have to shower. Things like that were kind of interesting in that book. But also, it's like that's kind of where like you get to that entrepreneurship, because it's that weird, unstoppable confidence that you have. It's like, the other day, Jason was talking about day traders and saying, day trading's terrible. It's very stupid. It's this, that, and the other thing. And it's like at the same time, like I do understand that, and I think most of us have started day trading and went like, okay, this is a little bit rougher than I was thinking, or I don't know how to make the type of returns doing this that I think I can. Mm-hmm. But at the same time, it's like that unstoppable confidence to like think you can just do something that nobody else has ever done, which is pull money out of the market every single day. Like that's what starts you as a good trader, I think, or an entrepreneur in general, like somebody who's going to start a business. Like, because if you start a business, and I've started many, every business I start, I take about a year to make money every single time. It takes a year till any real money's coming in where the business makes any sense. I lose money the whole time. I think it's, at some points I doubt myself and I go, man, well, do I really want to do this? And usually at some point it works out if you really stick with it. But you have to have that crazy, almost psychopathic part of your brain to continue to kind of hurt yourself to do those types of things, because it does work out over time. However, not everybody has that amount of time. Not to mention most people don't want to take it. It's like Phil Knight, like you said, you're 7 years in a job you hate to get to where you want to go. Not everybody's built to do those types of things. So I think there's a difference in it, but it's also why the reward of an entrepreneur is a lot higher than a worker, because you're just taking the risk. It's all risk at first, and then at some point you can possibly get to that next level.
Yeah, I mean, on the belief, the title of the Marcus, I keep coming back to Michael Marcus and these things, but I think there's a lot of value in that paper I wrote, but it was titled Unshakable Faith, and he had unshakable faith in his ability, whereas most people, you blow up once or twice, you're just like, this isn't for me. I'm not suited for this. But he talks about the scene in The Fiddler in the Roof where he looks up to God, and he said Marcus looked up to God and said, am I this stupid, or whatever his exact words were. But, and he said, no, I think I'll get it. And so he kept going. And so there's definitely some of that, because, it's I guess you have to have that belief and faith that it's going to work out. And maybe sometimes it doesn't. That's the other thing. Like, you just cannot know. So you have to be a little delusional. I'm reading Sam Zell's biography, And it's interesting because he's one of the origins guys. He actually kind of didn't go through a lot of struggle, in my opinion, relative to some other people. But he talks about his days as a cold salesman and how hard it is, and how an entrepreneur, which I guess you could argue a trader's an entrepreneur, really, right? Their business is making money in the markets, and their inventory is capital, what have you. But he talked about, and I don't remember the exact quote, but it was, rejection is like a key that people have to get comfortable with. If you can't get comfortable with rejection, you're probably not going to make it. And I guess the other thing I've seen with traders specifically is, for whatever reason, they're very obsessive about the markets, and wanting to succeed in the markets for whatever reason. Whereas I think most, we'll call them normal people, just say, this is too much work, this is too hard, or you lose a couple times and you quit. There's a great Gordon Gekko quote that I used to keep on my wall from Wall Street too, and he talks about, most people, they lose, they cry, they quit, and he says it's just like the first grade. Nobody likes a crybaby, and I try to keep that in front of myself to remind myself not to be a crybaby, because it's easy to do that when you lose. So, we still connected? Uh-oh. I don't know if I lost connection or if Jason did. Can anybody hear me? Be right back. Okay. Thank you, Fuzzy. Told me you can still hear me. So I guess Jason dropped out. But yeah, I mean, I guess he tends to kind of steer the ship on these things, but I'll just talk a little bit more about it. I really think that this idea of, and it's what I did with the Trader Principles book that I wrote, but it's, if you study the successful people, you start to identify patterns, and you can in turn use those patterns to essentially guide your own path. And once you do that and you guide your own path, you can get better, you can get better results. And that's really what I found with my own trading. It was, by studying the guys that were successful and identifying the principles that were consistent, I was able to incorporate those into my own trading, which led to much better results subject to goals. So anyway, I hope that's mostly clear, but give me 1 second. I'm going to try to reach out to Jason and see if he can get back on. Just got a text from Jason. He says his StreamYard shut down, so I'm going to sign off and see if we can start over with a new instance. Be right back. You there, Jason?
Yeah, we're back up. Sorry about that. I don't know. Somebody's working on my internet right now. So I think they just cut it.
You're kind of in and out. I'm not really hearing you.
Can you hear?
Coming and going.
Yeah.
Uh-oh. All your comms are down, man. Is there anybody still in the room? Can they hear us? Hello? Okay. Sounds like people can hear me. So, you mentioned one thing, Jason, earlier, just about, was that you? Jason Shapiro saying trading is hard. And somebody sent me a message that said, why don't people pay more attention to the principles? And there's an interesting quote from, it's the Of Dollars and Data guy. And it's, tell the truth to people that want the truth and you earn a living. Tell the truth to people that want a fantasy and you go broke, and tell a fantasy to people that want a fantasy and you thrive. And so I think people don't pay that much attention to the principles, because the truth about trading is that it's pretty hard. It's a hard way to earn an easy living, as people say. And, you get a lot of these things on X or Twitter or whatever we call it these days, just, $37 or $37,000 I made in the last hour, and just sign up and you'll get my perfect system. And that's just, when you study the people that have been successful, that's not really the way that it works. So, I guess getting back to is trading hard, the answer is pretty much yes, I believe that it is. And what you see is it's very rare for anyone to consistently make money in the markets. It tends to come in sort of fits and starts and clusters. And so, I guess the other thing would be, when you talk about principles, ride your winners, cut your losses, respect price action, that's not going to tell you which moving average combination is going to make you 100% with no drawdowns in the future, which nobody knows until after the fact. So I guess, sort of working on memory from what you said, and what somebody sent me away, but it's I think that the truth of trading is it's difficult, and you have to have these principles incorporated, but from there you really need to, come up with what's best for you based on what your goals are, like we've talked about before, and then what your temperament is, and you design the best system, cognizant that we don't really know what the future holds. So you might be wrong, and that might mean losing money. So anyway, I just, thought that might be interesting versus what you had said a little bit earlier. So are you still there, Jason?
I'm here. Can you hear me?
I can better, yeah. No, sounds like you went outside.
Yeah, I'm outside. Maybe it's more connected to the LTE at the moment, but we'll see. But yeah, no, I agree. It's trading is always very difficult, and I think that's a thing that we don't have enough conversations about, is how difficult trading can be, how you might be in these situations for a long time of learning how to trade. And that's got to be okay too. I mean, that's the thing about it. People want, it's like you said, if you sell the fantasy that you're going to be the best trader ever in 2 months because I did it and you could do it too, more people are going to buy your product. More people are going to be interested to hear from you. But if you tell people the truth of, hey, it could take a very long time, trading's really rough, you're probably going to lose a lot of money at first, nobody wants to hear that.
Yeah, I think that's right. I mean, I think the realities of it and the fantasy, I guess the fantasy is pretty simple. You buy some stocks or commodities or futures and you make a fortune, and then you can, and take your job and shove it, and you can spend the rest of your life doing whatever it is you want to do. But that rarely manifests itself from what I've seen. I mean, more often than not, I think there's a lot of struggle on the path to trading success. I know in my own case, I've gone through a lot of difficult times with it. And even now, it's markets are tough. I've been thinking a lot about how in a short term, and I wrote about this, maybe we talked about it last week, can't remember, but I wrote about how I think short-term trading is permanently altered due to high frequency traders, decimalization, the reduction in the cost of a computer, and then the proliferation of data. And I think that that's a trend that isn't going away, compared to 30, 40 years ago when those things were huge barriers to entry. But longer term stuff still works pretty well for me, but the shorter term has just been very frustrating. And I think we talked a little bit before you started the show, but it's like, how do you deal with those difficult periods? And unfortunately, there's really no one right answer. I mean, you can study what people have said. Some people say, rein it in, don't trade as large. When you're doing well, trade aggressively. When you're not, don't. Obviously, that doesn't work for a system unless you build it in. But I kind of like the Richard Dennis comment of, when you're getting beat to death, get your head out of the mixer. And that doesn't necessarily apply to systems, but I think it's good to sometimes just take a break, because when you start to lose, that can affect your head, what you're thinking, your emotions. You make bad decisions, that leads to bad outcomes, leads to more losses, and it's sort of a vicious cycle and a downward spiral. So anyway, I guess, back to that, and tell people the fantasy, like, obviously I'm not doing that. But I think the reality of it is it's difficult, and it takes a lot of time and effort. And really the best times are more a function of sort of like back to Phil Knight, right? He spent years waiting for to get enough momentum and for the ideal time to come for what he was doing. And I think it's the same with trading. We see these guys like Mulvaney make 100%, and think that, oh, geez, he's got some secret sauce. And I guess in a way he does, but it's like he's been doing the same thing for a lot of years, and finally the wind just caught his sail. So anyway, hopefully that's kind of helpful to hear, because it sounds like most of the audience likes to hear about the trenches. Yeah, I don't know.
I mean, it's kind of the audience I've always kind of catered to, even though I know there's pain in that. There's pain in that idea that you will really struggle as a trader for long, extended periods of time. And so kind of learning that and understanding that, and also understanding luck has to play a part in it. If you have luck on your side and you're kind of able to look at the markets as this thing that sometimes there's crazy trends and liquidity behind you, like, yeah, you're going to see those 100% years or 200% years here and there, but they're going to be very rare. I posted Mulvaney's returns the other day too, just so people can see that, because I think a lot of people don't understand. Like, they hear, you made 100% a year, and they think the year was like, 20% up, 20% up, 20%, like something like that. But really, it's like, no, he made 50% in a month. He made negative. He was down 20% the next month. He's up 10% the next month. He's down 15%. Like, that's how returns are. And I always say the phrase lumpy returns, because I think that's the key to doing this well, is like, make your drawdowns smaller than your gains. You'll make money, but don't get too down on those down periods, because they're just going to happen. It's impossible to avoid it.
I think that's sort of the lumpy returns. We all have this vision, or at least most people that I talk to in the real world, of basically like how an account sitting in a T-bill looks, where it's, you make money and then it steps up and it just slowly steps up. And that's probably why people like real estate, because it pays them a consistent quote unquote dividend until they have to replace parts of the real estate. But if you study trading, the returns tend to come in clusters, and it's sort of long, difficult periods followed by short windows of boom. And I think that's true of most business. I mean, you look at Hollywood and movies, right? It's like loss, and then there's one, they call them tent poles, that makes a ton of money and compensates for all the losses. And maybe that's true of life too. When you think about people who are successful, it tends to come in short bursts, and it doesn't always last. I I like Oliver Stone. I've read his biographies. I recommend them. He wrote an autobiography, and then somebody else wrote a biography, but they're very interesting books. The guy had a crazy life. But, he made a bunch of movies that early in his career, he had a really, really hard time. He couldn't get funding, couldn't get things going. And then all of a sudden it clicked, and he made Platoon and JFK and the other movies. And, he crushed it for several years. And I saw him on, I think it was Twitter, but either way, some social media platform recently. And he was talking about how he couldn't get money to finance his movies. And I thought that was just really interesting, because it's like, here's a guy who has Academy Awards, and he's very successful in his field over the long haul, but he can't get funding to make the movies that he wants to make. And so I guess the larger point is, maybe in trading and life and business and all of it, success comes in short bursts, and a lot of the rest of it's a grind. And even though, we might think or want to believe that because we hit this successful window that it's easy street after that, I don't know that that's true either. I mean, I think a lot of, and I wrote something about this recently, but it's like, I call it market legend bias. But we assess traders based on this idyllic window for their strategy, and we don't consider a lot of what came before or after. And I think that usually the windows that we focus on to call people the greatest of all time may not be replicable over time, for whatever that's worth. So I guess it's just a lot of hard truths here today, which maybe aren't that popular, but hey.
No, I think that's one is like, I wish I would have. It's one thing. I think there's two things going. Most of the time when people get into it, for example, my first business was in entertainment. If I had known how tough that industry was, I wouldn't have made a successful business in that industry. So that's also one thing. So you have to have that kind of crazy confidence still, like that, hey, this is going to work out. Hey, I'm going to do this. Hey, at some point, this is going to happen for me. Like, you have to have that crazy confidence still, no matter what. But also you have to understand the other end of it, which is this could take longer than I want it to take. This could take as long as it needs to take. And that's the thing. Like, I remember myself, I had a funny moment for me when I was first trading. And I literally remember laying in the bathroom on the floor. Like, and I am a person who I wish I could cry more, but I never cry. Funerals, whatever it is, I just can't do it. But I frustrated myself by, torturing my accounts and torching my returns over and over and over again, to the point where I was like laying on the ground crying, like, I don't know what's wrong with me. Why can't I do this? I need to stop doing this, but I just can't, like, it literally felt like something was like really wrong with me. And then I remember starting to laugh and being like, oh no, I'm like obsessed with trying to figure out how to trade in the markets. One day, I guess it'll work out. And it did. But at the same time, it's like that was part of the journey. And I don't know anybody that you could point out and say, hey, they just bypassed that part of the journey. They're kicking ass. They've been kicking ass forever from day one. Like, it's just, it doesn't happen that way. And I wish it does. I wish, I'm sure somebody will write us at some point and say, well, I've been trading for a year and I've been kicking ass all year long. Like, I'm sure that somebody could say that, but can you kick ass for 5 years in a row? Can you do it for 10 years? Like, these things are really, really hard to do. And that's the way you make real wealth over time.
Yeah, I think persistence and consistency are what matter. We should change the name of this from Free Your Mind to Dose of Hard Realities with Jason and George.
I honestly think it's still the same thing, though, right? It's still the thing where we're like, we are saying these things, which does help to free your mind in a sense of, hey, like, you're going online, you're looking at these dudes, and they're saying their returns are insane every day, and they're killing it every single day. And you just think that that's going to be you too. You're going to be this dude and you're going to subscribe to their channel and you're going to be the best trader. But really, I wrote this thing called Trading Heroes, which is basically like the journey you're on as a trader. So you first start out as a trader and you think you can do it. You go to, Bloomberg or whatever, you start to read news headlines and you think that's how it works, and it's not. And then you move on to like trying to find an analyst, and you find that you buy like 50 pieces of research and you figure out you're trying to do these trades that these guys are doing and it doesn't work. And then you start to like finally build your own strategies, build your own systems, figure out how to make it work, and then you become a good trader. And so more of it is freeing your mind from the point of like, hey, day one I'm going to be great, to hey, this is just like anything else. Like if you want to be good at you want to be Steph Curry on a basketball court, you're not going to start out shooting 50% from three in games, like it's just not going to happen. But you can put the effort in, put the time in, and years after this, like maybe 4 or 5 years, you can be a good shooter, but that takes a lot of time. And it's the same with trading. Maybe you start out, you think this is easy, you figure out it's a little harder than you thought it was, and then a few years down the road, you can become a good trader, but it takes time.
It's probably true of everything. I think the other things that are really difficult about trading are there's really no one right way to be successful in the markets. In the book I wrote, it says nothing works all the time, and I've got a bunch of quotes of people over the past 100 years saying that. So when you trade for yourself, you see that's true as well. There's ups and downs to every strategy. But the other thing that really is frustrating is you can do stupid things in markets and have great results for long periods of time. So I look at it as like a kind of a 4-square matrix, and it's like process, good and bad, outcome, good and bad. And, in theory, like take a diet. So if you decide you're going to exercise, you're going to eat right, you're going to get results. But just because you use a good process as a trader doesn't mean you'll get good results in any reasonable amount of time. I mean, hopefully over a few years you will, but I've seen people that have what I would call bad process or very aggressive process, lots of leverage, no stops, have great results for years. And in theory, that could go on for almost an entire career. But so that makes it even more difficult because you can kind of be like, but I'm doing the right things and I'm not getting the results, or the guy over there is doing the things that you're not supposed to do, and all the money wants to go to him, or her. And I think that's another thing that just like makes you kind of, it's frustrating. I guess I find more and more circumstances the older I get where it's like, oh geez, if the world worked the way that I thought was fair, that book keeps getting thicker as I get older, but that's not how it works. So, yeah.
That's a good point, because I think in general that's a feeling that most traders get, which is, why in the world can this, and also they think of people as stupid, like, let's be honest, like most people are pretty judgmental. We look at other people and go that I'm smarter than this person, therefore I should be doing blank better than this person. And it's like, I don't think trading's a thing on brains. Maybe even sometimes the dumber, simpler idea might be better. I don't know if anybody's watches the TV show The Bear. I thought it was kind of interesting. I just started watching the 3rd season yesterday. I thought one thing that was kind of interesting was the fact that they talked about simplicity in cooking, like making your dishes simpler and simpler and simpler. And as you keep getting simpler, you can become a better chef. And like, it's the same thing with trading. Is like, when you're sitting there and you're dicing everything up and you're turning it into this, like, filter system. Okay, I'm going to buy 50-day highs, let's say. Okay, but I'm only going to do it over the 200-day. And then the primary trend has to be right, and all these things. And you keep doing all these things, and you end up filtering yourself out of good trades. And then you go, okay, well, I'm a technical trader, but I also use these fundamentals, and I use this macro model. And, like, you could build this stuff into the most craziest, hardest to understand thing, to the point where you can barely understand it. Or you can kind of just get to the point of going, hey, this is the system. This is how I'm going to put together this system. I'm going to follow these rules. And at some points, the market's going to be in my favor and it's going to do great. And at other points, the market will not be in my favor and it's not going to do nearly as good. And that just has to be the way you look at it, because if you, unless you can trade, unless you're a person who can trade every single strategy well, and know the exact times to do it, which is impossible to do. That's the only other way to do it. That's why hedge funds will have ideas where they have like 5 different traders trading different time frames, different styles. One's a buy and hold, one's a value investor, one's a trend follower, one's a short-term swing trader. You kind of catch all of those, and that's the only way to really do that. but I don't think that works for individuals that well.
Yeah, I mean, I think if you put together too many things, you get, at least in statistical sort of T-statistics style trading, if you put too many filters on something, you'll find amazing results, but the world has to look more and more like your look back window for that to materialize. So most people that I know and have known in the quantitative space, at least, they talk about consistency and simplicity. But even that doesn't really absolve you of losses in the future. And I think the best sort of philosophy is to figure out what you're going to try to capture. Is it short-term trends, long-term trends, mean reversion, whatever, and then build a process or a system to capture that and accept that it's not going to work all the time. And from there, it's like, do you just do one that does short-term trends, or do you marry a trend system with a mean reversion or process? And there's no right answer, but I guess the one couple things I'll say on that is, the more things you put together, the more stable, as long as they're relatively simple, the more stable your equity curve will be, but it's harder to make as much money. And oddly, you would think if you put together these robust, stable solutions and then throw leverage on it, you could kind of cheat the devil. But in my experience, that always ends badly. It just doesn't work out for whatever reason. And so that's saying, like, okay, if I put together a mean reversion with a trend system and a short term with a long term, my equity curve goes from this to this, and then that only returns 7% on average. So I'm going to put 3x leverage on that, and I'll get it to 21 or whatever. But it never works out that way. I've always found that when I layer different systems, it doesn't necessarily blow up, depends how much leverage you use, but they don't play together in the future the way that they did in the past. So I've sort of gravitated toward trying to capture specific phenomena. And that's not to say that I'm necessarily right, but just for whatever it's worth, that's what I've had the best outcomes with.
No, I think that's a good point, because I think that's a thing that a lot of people don't understand. One, that when you're looking at somebody like Mulvaney's returns, you're going, man, I really covet that type of return, 100%, 50% years. You also have to take that type of upside volatility with the downside volatility that's going to bring. So understanding that, hey, yeah, I got these type of returns, they're great. But the only way to get those types of returns is to have the volatility the other way. You do not get upside volatility without it. So it's the same as, you want to create these strategies and have 50 different strategies. The Tom Basso talks about smoothing the potholes and all of these things. It all sounds really cool. However, it's going to take away from your returns. And the person who can kind of stick through those bad times with very little drawdowns and be around for those really good times where you're just hitting a bunch of trends, like, most of the time, that's the person that's going to make more money than and when you run more systems, most of the time what I found out, especially working at funds, is I'm making a great amount of money sometimes, and then there's some person losing the same amount of money in another account. And nobody likes to talk about that either. Is like, it's when you have all these different strategies, like, yeah, one's usually losing. Like, think about myself and Jason Shapiro. We talk about this off mic before, which is my systems will be in buy signals and trending, and the markets are trending, and I'm making money. And then it's the opposite for him. He has the other systems when he's looking for mean reversion trading, finding tops, any type of contrarian trade, basically. And, maybe, and he's very good. I'm not saying he's bad, but I'm usually outperforming him at those points. And he's outperforming me when the markets are in range bound territory. So, you have to really understand, like, what type of trader you are, how you're going to do that. Also understanding, Jason gets hired because he can hedge a trend following portfolio very well. So, that's part of his job, is to be the contrarian to trends. So, you have to understand these different types of trading, different types of trading systems, strategies, so you can really figure out what you want to do. Like, some people, they just want to gather 10% a year. Maybe you could have more of a Jason strategy. Some people want to hit these major trends and big returns. But I also think it's your personality type has to fit what whatever system you're building. Like if you're building a trend system and you don't like hanging on to trades for months on end and all the chop that kind of comes with it and the frustration, you probably shouldn't be a trend follower. Same as, if you kind of want to stay away from the market and not look at it every single minute of every day, like you don't want to be a day trader. Like, so, you just have to kind of understand exactly what type of personality you are.
Yeah, a couple of points on that, if we got a few more minutes. You said Jason gets hired. I've talked to Jason a few times. He's a good guy, but he gets hired because he hedges a trend portfolio. And I think the word hire is sort of critical. And I don't know that it's necessarily his goal to just raise money. I think he believes in his strategy. But I guess if you want to get hired as a CTA, your best bet is probably not to become a trend follower. If you want to raise external money from allocators, it's probably best to come up with something that'll smooth the aggregate equity curve of allocators, because that's what they want. They don't want another trend follower, and they don't want more long stock exposure. So the larger point goes back to that idea of goals. Are you trading for yourself? Are you trying to raise money? Who's your audience? What do they want? And that can alter the course. If I say, I'm just going to try to make the most money possible for myself, drawdowns be damned, that's a much different design process than if I say I want to try to raise capital from institutional allocators for whatever that's worth. So I guess another thing that you mentioned that I think a lot about is one of the things that I've seen with adding multiple systems. And yeah, I know guys who do it and I like those guys and respect them. I just have never had a lot of luck with it for whatever reason. And the other thing that's undeniable is your operational complexity goes up. At least if you're building quant systems, the more moving parts you have. And it creates all these headaches like, oh, if the data feed didn't come as expected, or what if I missed a signal because the data came late, or this one worked or that one didn't. And it just creates a lot of challenges. So you need operational infrastructure of one form or another to deal with all that stuff. And if you try to build systems, you're going to run into those problems. The more simple, the less time sensitive your orders are, your signals, the better is what I've found. And again, these achieve different things, but just the reality is the more complex, the more systems you throw at something, different time periods, the more operationally complex it becomes, and that becomes a headache unto itself. And I guess the final thing I'll say is one thing that I've found over time is I like systems or processes where I can explain to myself or someone else when I do well. So let's say I have a model that trades stocks, excuse me, on the long side. I know that if stocks go down, I'm going to lose money. And if stocks go up, I'm going to make money. And I may not be exactly related to the index like the S&P 500, but it's very clear the environments where I'm going to make money and lose money. The more complex it gets to explain when you'll make and lose money based on the moves in the underlying assets that you're trading, so stocks, bonds, what have you, I think the worse that is, because you've got more complexity and that tends to be difficult. So if it's like, well, after the 19th down day with 2 up days, if gold is here and interest rates have done this, that's a very, very specific thing. And if you layer 20 or 50 of those systems together, it's like, when do you make money? And the answer is, well, when my systems work together well. For me, that's something I try to avoid because I just have found it to be too complex. And that's not to say it's wrong. That's probably what Rentech's doing, and they're obviously doing better than me. But just for whatever it's worth, I think that, for most people out there, the more you can stick to some kind of simplicity, avoid operational complexity, the better in a lot of ways.
Yeah, and so no, perfect way to end that. And then so one last thing is a question: is trend following the only type of system that has positive skew on its return distribution? And would that mean that it's the only type of system that works with position sizing? And I can answer some of that, and then I'll pass it to George, and then we'll hop off. But the answer to me is no. So mean reversion systems do make money, and actually there's less drawdowns in a mean reversion system. However, you're going to have to be more into equities or really mean reverting. They make a lot more money in mean reversion systems. Same with crypto. They make some money in mean reversion systems, but the same thing in commodities. It does make money over time, but it's not as good as a trend following system. So, I know of a fund that basically uses two different types of strategies, one in equities, one in the commodities. So, like, you can make money in a lot of different ways, and position sizing works across the board. So you always have to use position sizing no matter what type of trader you are to make money, because you have to think about it this way. If you're risking, a dollar to make $5, you'll always make money, and that doesn't matter the type of system or strategy or how short term or long term you are. You have to just kind of figure out how that type of strategy works, and then back test it, make sure it's right, over 40%, 50% of the time. And then when you go forward, take that down a little bit to like 30, 40%. And then you'll probably make money over time. Risk management and position sizing is everything, and it doesn't matter what type of trader you are.
I guess to the extent I fully understand the question, I would say that to have a profit, that would mean that your average has to be greater than zero. So you would have to have a positive skew. So any profitable system, by definition, if you're looking at like a bell curve, is going to have an average of greater than zero. So it would have positive skew, I think. But I'm not sure if that's correct. But yeah, as far as position sizing, again, as I understand it, trend following sizes with ATRs for the most part. And in quantitative systems, one of the things that you find is there's really kind of two camps. There's trend following systems, and then there's T-statistic based systems where you do an analysis of historical prices and you come up with something that's statistically significant, high probability of a positive outcome. And the latter camp, the T-stat camp, has no real good way to build portfolios. And if you study the guys who do it well, they talk about that. It's like, well, how much do I allocate to this system versus that? And I don't know how the big fund managers do it. The ideas that I've always had were to either take a collection of systems and run them through something like an efficient frontier from modern portfolio theory, and say, with these sizes, this is how these systems play together. And then, reset that every so often, monthly, quarterly, based on outcomes, like optimize, for lack of a better word, the proper weights in portfolio. The other thing that I've thought of is you could take, so trend following systems use ATRs of the prices of markets. You could take the high probability T-statistic trading systems, turn their equity curves into basically price streams, just like like the price of a commodity. And then you could use a trend following ATR sizing system to size the individual systems within, and you could stop yourself out on the systems and such too. So I've never actually done that, but I think if I'm not so far down the rabbit hole that people are falling asleep, that's what I've thought in terms of applying position sizing to other systems would work. You get basically a collection of high probability, as measured by Z-score, T-statistic, what have you, systems, and then you put them together and you turn the equity curves of those systems into price streams, and then you go grab the trend follower approach of how to build a portfolio and apply it to that, all those price streams that you've created from the T-stat statistic systems, if that makes sense. I know, like, that kind of math is difficult to talk about without whiteboards, and to most people, it's probably just mind-numbingly brutal. But anyway, yeah.
But that's honestly, like, that's these things that we're talking about right here is exactly when you start to become a good trader. You understand that drawdowns are part of trading. You understand that position sizing is everything. You understand that, you create a system or strategy. It doesn't mean everybody has to be systematic to make money. That's not true at all. But some sort of reasons why you enter and exit a trade, and make sure those have a positive expectancy on those returns. And next thing you know, you are making money over time. So thanks for that question. I always appreciate you coming on, Peruse. So, all right, George, we made it somehow. So thanks, guys, for sticking with us through the all the technical difficulties we were having. My Wi-Fi just got turned down again right now. Phenomenal. Great timing. So, all right, guys. Well, thank you guys so much for coming on, and we'll see you soon.
See you guys.
Ugh, okay.